Amazon rebounding a bit over the last 3 months, up over 30%, recouping some of the company's losses since the beginning of the year. Shares are still down double digits when you look back year to date, though. But is now the time to jump back in? Our next guest saying the worst is firmly behind the e-commerce giant. Joining us to discuss, Stifel analyst Scott Devitt maintaining a buy rating on the stock, upping his price target to 200 after a strong quarter. So that implies, say, 30% upside from here. What do you think are the key drivers that you would say now's the time to buy Amazon?
Good morning, Leslie. I think the key drivers are, as you described, that the worst is behind. Much of it was the presentation of comparables as the company was coming out of the pandemic. So as you enter into 2023, you're going to have gross merchandise value on the retail business accelerating, the revenue in aggregate of the business accelerating. AWS in 2023 should exceed $100 billion in revenue. And maybe most importantly, margins are in the process of bottoming right now, and on a calendar basis should improve from 3% in 22 to over 5% in 23. So that tends to be the best time to own Amazon shares when margins are rising. And I think the stock has a good 30 to 40% more upside over the next 12 months.
Does that require a pretty accommodative macro backdrop for that thesis to take place, or is it kind of idiosyncratic regardless of what happens with inflation, regardless with what happens with rates and other factors here?
It would require a relatively normal macroeconomic backdrop. So, Amazon would not be immune to a material deterioration in economic trends. But from a base case standpoint, with neutral economic conditions, I think you can make those expectations that I described, and you have a stock that's now depressed because it's been being priced off of these most recent comps. And as that reverses, you get the continuation of the rally that's already begun.
Scott, to what degree is this process of Amazon trying to rationalize some of the overinvestment and overhiring that they've talked about in the last quarter or so that has to be done? There was a sense out there that almost they were bearing the burden of a lot of the logistical costs that were going up and then investing kind of indiscriminately on top of that. So is that going to be a process we live with for a while? It's going to either hurt margins or sentiment toward the stock?
It could, but we're also coming out of that. I would make the argument that, counter to, I think, the current consensus view that Amazon didn't really do anything wrong during the pandemic. Costs increased, oil prices increased, the cost of labor increased, logistics costs have increased that were outside of their control. And then the things that were inside of the company's control, which was managing to a peak that no one could have imagined when or at what level it would be, that they're now coming off of, is just the natural kind of evolution of post-pandemic business. And Amazon, interestingly, during the pandemic, the headcount of the business doubled from 800,000 to 1.6. We've now come about 100,000 off of that peak. But even more impressive, the fulfillment center footprint. The company added more fulfillment center space during the pandemic than it had in its entire 25-year existence prior to that. So there's some normalization coming out, and we're seeing that now. But that's also what ultimately, as they grow into that, contributes to margin expansion in coming